Hi, and welcome to the Hobart Weekly, a series created for our clients to bring you relevant financial planning insights, timely updates, and helpful perspectives each week. I'm Corey Sundstrom, Director of Financial Planning and Senior Wealth Advisor here at Hobart Wealth. Today, I wanted to talk with you about taxes in retirement. One of the biggest mistakes I see people make in retirement is thinking their tax bill will just naturally go down once their paycheck stops. Sometimes it does. Sometimes it absolutely does not. In fact, a lot of people spend their working years stuffing money into tax-deferred accounts, then retire and realize they've built themselves a future tax problem with really good intentions. It is a financial equivalent to cleaning your house by shoving everything into your closet and hoping nobody opens that door. So how do you find your ideal tax bracket in retirement? You start by understanding that retirement is often your best chance to be intentional about taxes, especially in the window between when you stop working and when required minimum distributions begin. During those years, your taxable income may be temporarily lower. That creates room, and that room can be valuable. The question is not, how do I pay the least tax this year? The better question is, what tax bracket am I willing to fill up now so I can potentially avoid a bigger tax problem later? For a lot of retirees, that means looking at the 12%, 22% or 24% bracket and asking whether it makes sense to realize income on purpose. That could mean Roth conversions. It could mean taking extra withdrawals from IRA money before required minimum distributions begin. It could mean harvesting gains strategically in their brokerage accounts. The goal is not to avoid taxes forever. That's not a thing. The goal is to control them over time. So here's a simple way to think about it. Step one, estimate what your income will be this year before any planning. Social Security, pensions, part-time work, investment income, whatever applies. Step two, look at where that puts you in the tax brackets. Step three, ask, do I have the room to intentionally recognize more income before I jump into the next tax bracket that feels uncomfortable? That is your planning zone. For some people, the ideal bracket is the 12% bracket because they want to stay conservative. For others, it may be the 22% or even the 24% bracket because paying a known tax rate now can feel better than getting hit later with larger required minimum distributions, more Social Security taxation, or higher Medicare premium surcharges. That is the key point. Your ideal tax bracket is not necessarily the lowest one. It's the one that creates the best long-term outcome. What should you do with this? Well, first, pull up last year's tax return and identify your taxable income. Then estimate what that number looks like in retirement before you start taking required minimum distributions. Lastly, figure out how much room you may have in that current bracket before crossing into the next one. Because in retirement, good tax planning is not about hiding from the IRS. It's about choosing your tax bill with more intention while you still have the opportunity. Thanks for spending a few minutes with us on Hobart Weekly. We hope this was helpful, and we look forward to continuing to share insights that support your financial life. We'll see you next week.